It's been the strangest of year for stock markets, making all-time highs into February, then fell off a cliff as the coronavirus pandemic spread. But since then, looking here at the NASDAQ 100, you can see just the size of the recovery off those March lows. So a big part of the recovery for stock markets has been driven by big tech, the names we all know. And that's what I'm going to talk about in this video. 5 different companies. Do they have further to go? Or actually, is this bounce back off the lows overextended? And actually, we're due for something of a correction for the major well-known tech stocks. Hello, I'm David Jones from Capital.com. And this is a slightly longer video than usual, but we are covering 5 different markets. In this, we're going to take a look at the so-called FAANG stocks. We're going to take a look at Facebook, Amazon, Apple, Netflix and Google. Look at some of their recent earnings, look at where the share price has gone, look at the technicals, see if there's an opportunity and whether we can set a trade up. So as usual in this, I'll be talking about the companies, then dipping in and out of the platform, looking to set up these trades and looking at things in more detail. If you're watching this and you're not subscribed, if I could ask you to subscribe, it does help support the channel, build our numbers, and means we can continue to push out lots of hopefully interesting and varied comment on markets in the weeks and the months ahead. So let's get things started. Let's talk about the broader market first of all. We've seen this great comeback by stocks off the March lows and setting positive performances for the year to date. And a lot of that has clearly been driven by the tech sector, particularly the sort of companies we're going to be talking about in this video. Look at the NASDAQ. That has rallied by 65%, the NASDAQ 100 off those March lows. So an incredible comeback. Since June of this year, the NASDAQ 100 has been setting fresh all-time highs. And I think there are very few of us that would have expected that when we were in the eye of the coronavirus storm back in March. And clearly, the so-called stay-at-home tech stocks have done well out of the lockdown that we've seen around the world. It does seem obvious in hindsight, of course, but the likes of Amazon.com, clearly much more online shopping as grocery stores are locked down and people were encouraged to stay at home. Netflix, stuck at home, not much to do. What should we do? Let's watch a box set on Netflix, added more subscribers. So these companies have done particularly well. But as usual, I think the question is, when we look at all of these, has the run gone too far? Clearly, no market goes in one direction forever. Are we seeing a favorite word in recent videos on gold and silver, this FOMO effect, fear of missing out, ever-increasing prices, bringing in more and more buyers and just setting ourselves up for a big correction? Let's take a look at these individual stocks. Let's get started. So let's kick things off with the granddaddy of social media. So Facebook, we had its latest earnings out in July. And back then, it showed actually its slowest growth in revenue since it first came to the market, since it IPO'd in 2012. But despite that slower growth, it still beat market expectations. And earnings, clearly, company results are all about expectations. If the market's expecting that, does it come in here? Does it come in here? But we did see Facebook beat expectations. It said it had grown its number of users, again, continuing to spread its tentacles around the world. So it had 3.14 billion users versus 2.99 billion in the previous quarter. Earnings per share were really quite an incredible beat in the end. Facebook earnings per share in the latest quarter were $1.80. That was versus about $1.40, $1.39 that the market was expecting. So a massive beat there, and as you'd expect, a positive reaction by the shares. So we've seen a strong performance by Facebook. They've moved out to all-time highs in May. Classic breakout. When we see this in lots of stocks, from a charting momentum point of view, if it breaks out to an all-time high, it does suggest strength in the market. We've seen it in other markets, for example, like gold more recently. And this means a really positive performance. So for the year to date, at the time of recording, Facebook shares were up around 28% for the year to date. So let's take a look at the chart, look at the levels and see if there's an opportunity. So here's the really strong recovery in the NASDAQ. Broke out to fresh all-time highs in June of this year and has carried on powering higher. And the big names, the Amazons, Apples, Netflix, Facebook, they have all played a major part in dragging broader stock markets higher. So in this video, we're going to take a look at 5 of these so-called FAANG stocks in more detail. I'm going to jump backwards and forwards, talk about them, come onto the chart, see if there are trades to do, and see if we can maybe make some money over the next few weeks. At the moment, if we take a look at existing trades, we do have a trade running on Apple. We bought back 24th of June when they were trading at $367. They've moved about $100, almost $100 in our favor. So we do have some exposure to tech stocks, but we're going to see if we can add to that. When it comes to the other trades, the other big winners at the moment, natural gas. We did a video on that earlier in the week. Take a look at that if you want to. And that euro US dollar that has benefited from the dollar weakness, but maybe things are changing. And I did add a dollar yen trade in beginning of the week as well. But let me talk a bit more about these major tech stocks, then we'll jump back and see if there are opportunities still to come in the weeks ahead. So here are the moves in Facebook. So for all of these stocks, I've got a 20-day moving average on. The white line you can see here. We'll have a look at the RSI to see how extreme or otherwise it is in the short term. But Facebook in March traded as low as 140. And then up to that most recent high, you can see it pretty much doubled off those March lows. We had a bit of, I think what's interesting here is what was going on sort of May through to the end of July, which was, of course, those latest earnings. We had a bit of sort of to and fro. That old all-time high that actually goes back to 2018. So for a couple of years, $220 a share had been quite the barrier for Facebook. Broke through it, chopped around, and finally found some more legs again coming into August after the latest earnings. And I do wonder, does this mean for the rest of the year we're going to see Facebook continue to push higher? You know, we've broken out once, breaking out again. So what I want to do now is focus on the trend from March. And I think there's definitely an order that can be placed here to see if we can jump in on this trend. So here's our trend line since March. That trend line's coming in currently around $240 a share at the time of recording, ahead of the market open. Facebook shares closed the previous day at 262. So for me, I'd quite like to be a buyer of Facebook. Looking at the RSI down here, it had popped into overbought beginning of August. Not surprising given the strength. It's come out of it slightly, but we're still pretty much an extreme. So what I would like to do is be a buyer if we get maybe a bit more of a sell-off, not too drastic a sell-off, but perhaps if it drifts back to 250, which is really only the lows from the first week of August. So I'm going to put an order in to buy at 250. The most aggressive place my stop would go, I think, would be underneath these lows just before the earnings, late July lows, around 225. Let me give it a bit more room, though. I'm going to put a stop the other side of, 206 were the lows in June. Let's say I go 200 on a stop. So I want to buy a dip back to 250, put a stop in 200. Nice, easy numbers for me to remember. And I think for me, as long as these old levels hold, this old low from June holds, that trend is still very much intact. Let's put our order in. So, like I say, I'm ahead of the market open. The market opens in about an hour. The US markets. I want to buy though if the price drifts to 250 a share. Buying 6 shares at 250. If that order gets filled, put a stop loss in at $200 a share, and it's the usual risk, slightly more. £228 is what we're risking. We normally risk around a couple of £100 on these trades. Let's send that one through. So that order's going to sit there. So what I'm really looking to do is pretty straightforward. Just buy into this trend. That trend still seems strong. We've broken out again. So for me, any dips in Facebook still look like buying opportunities. Next up, we are going to talk about the online retailing giant that is Amazon, Amazon.com. Its latest earnings absolutely smashed through analysts' expectations. The top line came in strong, revenue of $89 billion versus about $81 billion expected from Amazon. And clearly, of course, this is a company that has benefited from the global lockdown. After an initial wobble, as stock markets fell around the world coming into March because of the spread of the virus, quickly investors saw that, well, who's going to do well? A company that can supply almost everything you need online. So we've seen a massive boom in business for Amazon, and of course a corresponding lift in the share price. But Amazon, of course, isn't just online retailing. It also has Amazon Web Services that provides cloud computing to so many different companies around the globe. And the quarterly revenues here had done well. They were up by around 29% year on year. So a strong performance, it seems, from all aspects of the business, which translates into a great return for investors. At the time of recording, if you look at Amazon's share price, it's up, I think, a frankly staggering 70% for the year to date. So has it gone too far? Where's the opportunity? Let's take a look on the platform. Here's the Amazon chart, and what an incredible success story. Going back here on the chart to 2013, when the shares were about $250 a share, that sort of level, $3,170 a share at the latest closing. And what I want to focus on is really what's been going on this year. So 2020, let's just zoom in to that bit of the chart, take a look at the moving average, have a look at the trend and see if there's an opportunity there. So here's the year so far. So they traded off, they fell off those highs at $2,200 a share, dropping down to $1,600. So not quite a 30% fall from Amazon, but you can see pretty much doubled since those March lows. Clearly, not surprisingly, the lockdown has driven a lot more people than normal to online shopping and has boosted Amazon's business. Let's just pick up on this trend off these March lows like we did with Facebook. So at the time of recording, that trend line has done a great job. We've got loads of touches on the trend line. The 20-day moving average has done an okay job as well, as sort of providing support. It doesn't spend that long below the 20-day moving average when it does go below it, and it quickly flips above. So for me, I'd probably like to be a buyer up here. We've maybe, for fans of patterns, we've maybe got a triangle pattern going on, which is normally seen as a pause in the trend before that continues. The tightest I'd want my stop is the other side of 2,900, that sort of level. But actually, probably to give it a bit more room, I'd place my stop at below 2,600, which gives me an issue actually, because with the shares trading at 31.70, if I put a stop at 2.6, then my stop loss, even on one share, is going to be $500 away from where the market's trading. And on this size of account, where I limit the risk per trading idea to £200, I can't even buy one share. So maybe we will see share splits from Amazon further down the line. So for me, because of the risk involved there, it's not a trade I'm going to take in this instance, but that trend still looks pretty strong. Be looking for a run back up to these old highs, run about 33.50, that sort of area. And for me, it's only if it falls below 2.6 does it look like that trend in Amazon is over. It's interesting, it has lagged a bit since mid-July. We are seeing this bit of a sideways consolidation. It'd be interesting if we can wake up and break back up to these old highs and perhaps start a new trend higher. But I'm going to have to pass on a trade for that one. Next, we're going to take a look at a company that remains a darling amongst many investors. That is, of course, Apple. So its latest quarterly earnings showed the best ever revenues for the company. And these were up 11% year on year. Earnings per share came in at $2.58 a share. That was against, I think, around about $2.10 expected, so beating expectations here. And this has seen the shares, yet again with Apple, it's a recurring story. The shares have moved out to all-time highs. So this means for the year to date, the share price is up by more than 50% so far this year. So again, a cracking return for investors. We do have a 4-for-1 share split coming for Apple. That's, I think, at the end of this month. So what this means, if you hold one share of Apple, you'll end up with 4. So, of course, the share price, if it's trading at 400, will then be trading at $100. It doesn't affect the value of the company, but companies do this, they say, to try and widen the share ownership, make it appealing to other investors. But anyway, let's jump into the chart, take a look at Apple and see where the opportunity might be. So here's Apple. Just as a reminder, let's remind ourselves the existing trade on Apple. So the Apple trade bought 6 at 367. The market's 460. I have moved the stop up already to 390 on that. So locking in some profit, but giving it room to move higher again. So I'm in a risk-free trade with a bit of profit on Apple at the moment. So I'm quite happy to add to that. So Apple shares went from above, $320 a share, $320 a share, sliding down to $220. And since then, great recovery. You can see the 20-day moving average. A great job on the way up, providing support. Little dip below in late July, but the market recovered and off it went again to trade, well, pretty much at the moment, at all-time highs again. This is it trading pre-market, so you can trade Apple pre-market with us, trading at 460 at the moment, but all-time highs yet again yesterday. So for me, if something's making all-time highs, I'm not looking to sell. I'm not going to sell into that sort of momentum. I want to be a buyer. The only question is, am I a buyer on more strength, or do I wait for a bit of weakness to be a buyer? I think what I'm going to do again with Apple, like we did with Facebook, is place an order to buy. If you look at the RSI down here, we're a bit extreme, well, pretty extreme on the RSI. We have been extreme. That isn't uncommon in strongly trending markets. So it can be an expensive game to wait for RSIs to unwind before you jump in, because you can miss out on further strength. But for me, what I will do, I'm going to put an order in to buy just at 420. So about 10% below where we're trading now. Put an order in to buy at 420. And for a stop loss, I go the other side of these lows. So these lows right on that trend line, July the 24th trend line, stop loss in at 340. So I'm a buyer at 420 with a stop at 340. Let's set that up. So I'm stretching my risk again a bit on this one, but I'm going to buy 4 at 420 if the price trades to 420. If that order gets filled at 420, then put a stop loss at 340. And then I'll look if the market moves in my favor after, if I do get filled, I'll look to move the stop up. And the normal risk is £243, so a bit more than our normal couple of £100. But I don't expect all these orders to get filled. Let's place that limit order. Now, of course, if we could wind the clock back, and if we thought about it, one company that was potentially going to do really well out of everyone being stuck in at home was streaming video providers. Netflix, of course, has seen a real benefit in users. So let's talk about this one in a bit more detail. So its latest earnings were announced in mid-July. And we had actually something of a mixed bag in the end of earnings for Netflix. We saw them come in worse than expected in terms of earnings, but much better than expected in terms of their top line, in terms of revenue. So the market was expecting earnings per share of about $1.80. They missed that by a fair bit, I suppose. They came in at $1.59. But new additional subscribers is where we saw the surprise, perhaps not surprisingly. The market was expecting around 8.2 million new subscribers to be added. And by the end of it, Netflix has added slightly more than 10 million new subscribers in the quarter. Its guidance for the quarter coming up, I think, may have been a disappointment for investors. It said that it expected perhaps 2.5 million new subscribers in the next quarter. The market was expecting slightly more than 5 million. So Netflix taking a slightly cautious outlook after the surge it experienced during the lockdown period. And I think they have sort of paid the price on the market. If we have a look at the shares, they have slipped since those numbers came out. But is this an opportunity? And the share price is still up almost 50% for the year. Let's take a look at Netflix in more detail. So here's Netflix. We go back to July 2018. And you can see the high was in around $425. Sorry. And finally started pushing through it, although not that convincingly, but sort of April, May this year. Then we had that surge higher up to 575. And then we've had these earnings that have come out. They've been slightly disappointing. So again, I think what we need to do here, let's pick up, maybe there's a short sell in here. Let's pick up on the trend from the March lows. So there's our trend off the March lows. And I do wonder if maybe short selling Netflix is an idea here to perhaps balance off some of the other bullish positions that we're planning on taking. Perhaps they have overshot to the upside, and their guidance was quite cautious for the next quarter. So we had this trend where the price had moved up. That trend did a good job. It has fallen out of the trend in the last few days or so. We've had, a fairly decisive move so far below this 20-day moving average. We'll see how that one turns out. The RSI has approached oversold but hasn't got to oversold. But I just wonder, is Netflix the one that has got slightly ahead of itself? So what I am going to do, I'm going to sell short, but I'm going to put a stop loss. I think perhaps the other side of the mid-July highs. So those mid-July highs up at 575. So I'm going to sell short. Let's say 585 for a stop. Let's set that up. So I can sell fractional shares here, and these are trading ahead of the market open. So I can sell, what I'm going to do, sell 2.6 Netflix, where the market is now, 482. Put a stop at 585, the usual risk of a couple of £100. Let's send that through. So that's it. I've opened a position here. So what I'm looking at doing really is are we going to see Netflix drift? That's my view here. Have we seen it sort of spike higher, reverse quite quickly off those new highs, and perhaps we'll see it slide a bit from here, pulling back more into that range from March, April, sort of round about 400, perhaps even sub that. We'll come back to it and see how it does. And finally, let's take a look at Google. So Alphabet Google saw its earnings decline for the first time year on year, if we compare the quarters, so decline in revenue, I should say. And again, perhaps this isn't surprising. You know, we saw this massive economic shock of the coronavirus, lockdown, and plenty of advertisers really pulling their spending on platforms such as Google to try and see what was going to happen next. Although the company did say that as the quarter came to an end, it did see spending and revenues getting back to a more normal basis. And I think we've seen this with lots of companies. After that initial shock, you know, everyone has to clearly try and adapt to what is the new normal. Alphabet itself said that it had cut its own spending in half and had put a freeze on hiring in the second half, you know, due to the uncertainty around the economic outlook after these lockdown periods were eased. But its earnings still came in better than expected. You know, despite that drop-off in ad spend, it still saw earnings of just above $10 a share, and that was versus the $8.21 the market was expecting. So still a strong performance. The shares are positive for the year, perhaps a bit more modestly positive than some of the others we've looked at, but Google shares, Google Alphabet, still up by about 10% for the year to date. Let's take a look on the platform and see if there's an opportunity here because they've lagged behind the rest. And here's our Google chart. This really has been the laggard, relatively speaking. But look at some of the moves. We did come into 2020, setting fresh all-time highs up at $15.25. Then a significant reversal, losing about $500. So I think what we need to focus on is what's gone on this year for Google. So Google sells off down near $1,000 a share. We get this recovery. Let's pick up on that trend. And a bit like Netflix at the moment, it is sort of stuttering around that trend line. So I think that there are two approaches here. If you think those sort of those moves in mid-July, early August was the start of a Google breakout, pushing through those old February highs, you know, there's an argument to be a buyer where we're trading now, around about $1,500 a share, with stops the other side. I would say the closest I'd want the stop, the other side of the late June lows, and they're coming in around $13.50 a share. There's also an argument for going short. If you think that the Google, you know, really hasn't pushed out to fresh all-time highs for a couple of weeks now, lagging behind the rest of the market. If you thought, well, actually, maybe Google's rolling over, there's an opportunity, I think, to go short here. You know, selling at $15, $16 a share with stops somewhere above $1,600 a share. I think what I'm going to do, I'm going to wait this out. We'll come back to it. I think it's a little bit inconclusive at the moment. It's still hugging onto that trend line. So perhaps we'll have a bit more of a last-minute surge from Google, and it picks up strength from here. But it's a bit inconclusive. This break, the break through the old highs was a bit inconclusive as well. So I'm really not quite sure what to make of Google at the moment. So I think sitting on your hands and not doing anything is as much a trading decision as buying or selling. So we'll leave that one there. We'll wrap things up there. I hope you found it interesting. We will see what the second half of the year brings for these tech giants. But from me, David Jones, and Capital.com, good luck with your trading. For more trading videos just like this, please subscribe to our channel.